Well, thank you for that, everyone, for being patient. So we're back online. So welcome, everyone, REEP investors, apartment investors, and guests to our REEP huddle. And today is December the 11th, just after 12 o'clock. And Arleen and I have an interesting lineup for you today because we're going to talk a little bit about some underwriting, give you a glimpse on what's happened for this past year for our underwriting. And then we're going to talk about some political shifts that we're seeing and how it's going to affect what we believe is going to happen in 2025. Economic data. We've got some interesting economic data we would like to share with you. And then we're going to talk about REEP residential, operational excellence in our culture. So, Arleen, ready to get started on this and
ready to go. This year flew by very, very quickly. And so this is all about kind of a year in review, what we saw, what we expected, and then kind of what we're looking at today. So glad to have everyone with us.
All right, let's get rolling. Let's talk about the acquisition and underwriting that you guys experienced today.
Definitely. So let's get to that slide.
And we're getting there. All right. You could probably start talking about as overview.
There we go.
Arleen. There we go.
There we go. So it was a slower year. I think a lot of multifamily owners would agree with that. Basically, for us, we continued underwriting it. We continued looking at everything that brokers brought to us to see if it made sense. And we did tighten up some things just because of where we are in this cycle. I've said it before and I'll say it again. We are at or near the bottom of this real estate cycle, which is exciting from the standpoint of what we buy today can only go up. So that's exciting for us. So in the process, though, what did we do different? Well, we've always looked at leases, the new leases coming into properties. We always get a new rent roll throughout the process of acquiring properties. But this time we did an even deeper analysis of the last 30 new leases for a couple of reasons. Because there were some shifts in rent growth throughout the country, we wanted to see what was happening at the particular properties that we were looking at acquiring. We did acquire 2 assets, and I'll talk a little bit about that later in the huddle. But what we were looking at is, are rents going up or are they going backwards? And so this last 30 lease analysis you see in front of you to the left is kind of the rent roll. It is the rent roll. And then looking at our analysis of what's the average delta, meaning what's the average difference between the last 30 leases. You can see the example in the middle column showed that, rents were going up. And then the last, 15 leases, the last 10 leases, and the last 5 leases. Of course, the last 5 leases were the ones that were signed by the property most recently. And so we were watching that trend. Are they going up? Are they going backwards? Because that would impact what we paid for the property, because really we're buying the income stream of a property. So, so that is helpful for us. The other thing we're looking at, everybody's read about all the new supply in the different markets across the U.S. In the Sun Belt states in particular, there was a lot of deliveries of new units. And that's because the market believes that's where all the growth is happening. So we did always look at new deliveries that were planned, but in this case, we looked at them a little bit closer. You can see that new construction analysis chart to the right there, and that just shows the subject properties where we're buying what is being built near that area. Because if there's a lot of new supply, it will impact occupancies and it will impact rents. So that is something we look at really closely. And luckily, the 2 that we did buy this year, there was very limited new supply because there just wasn't land in the area to build. So that's good. The other thing we looked at is an even closer look at the physical criteria that we look at. We start with crime, always start with crime. If the property doesn't pass our crime test, then we don't even look at the numbers. But now we're even looking at things that we've always looked at, like we want to see 100% washer dryer connections at these properties. If the units themselves already have washer dryer units in them, even better, because that's a revenue opportunity for us. And boiler systems. So boilers really provide heat to units at a property if there isn't individual HVAC systems in the unit themselves. Well, if we're buying a property with a boiler, then that means at some point we will have a big expense to either repair or replace that boiler. So really today, unless there's an extraordinary reason, otherwise we will not be buying properties with boilers. And that's because it's an unpredictable item for us. The other thing we do is we are sizing our acquisitions for tier 3 financing. So there's tier 1, tier 2, and obviously tier 3. So tier 3 financing, it really, we're underwriting to that when we're looking at a new property. It does have a higher debt service coverage ratio requirement of 1.35x, but it also allows us to forego escrowing for insurance and taxes through the lender. Now, on our side, we will always escrow for insurance and taxes if the lender isn't doing it. But there's always a timing difference between what for example, taxes. If the county values a property for $5 million more this year, the lender's going to automatically start escrowing for taxes at that higher number, even though we know we're going to protest and we've always historically gotten it much lower. The lender doesn't take that into account. So they will pull money with the mortgage at a higher rate for those taxes, which means there's less cash flow at the property. So when we can control that process, then we do, and that's through a tier 3 loan, which is what we've gotten consistently. So just to wrap it up, we've continued to underwrite. I think we looked at 180 properties that we underwrote this year. And as I said earlier, we only bought 2 of them, and we'll tell you why. So that's really the acquisition side of it. Let's talk a little bit next about kind of the economic and political shifts. But before we do that, Jacob, I know you wanted to talk about some things that were very notable that happened in our industry. So you want to start us with that?
Sure. So let's talk about to kind of frame the political shift that we're going to talk about, things that have already happened. The Biden administration passed a ruling called the Corporate Transparency Act. And that basically was a requirement to file with FINSA beneficial owner information. And this is regarding all entities, partnerships, LLCs, corporations. You have to file that beneficial owner information. And that basically boils right down to the individual who is responsible for the entity. So that was in motion for all of us to prepare and get in by the end of the year. Texas filed a lawsuit against Merrick Garland, the Attorney General, and the suit was granted a temporary injunction December 3rd. So this is nationwide, by the way. So FINSA released a statement basically saying, look, we're going to go ahead and stay this, to put a temporary stay on it. It's voluntary now. So that's one that's already happened. The other one is the Department of Justice filed a lawsuit against RealPage. This is back in early 2024. And the DOJ basically said that RealPages, which is a property management software program, that their software allowed landlords to coordinate rental prices, basically collusion, basically, and harm renters from paying an honest rent. And of course, it's the free enterprise system that always wins, and we all thought that was bogus, but the Department of Justice did not. That lawsuit last week was dropped by the Department of Justice. It's Janet Yellen um, uh, group that did that. So the new, what am I trying to say here? The new administration has Scott Bessent coming in as the new Secretary of Treasury. And I think as a result of that, we're probably going to see the tax benefits of actually it's the Jobs Act. If you guys recall, bonus depreciation was created during the Jobs Act, if I'm not mistaken, by the Obama administration. Those are set to sunset in 2025. And we think we're going to continue to see those moving forward. The other one was the Attorney General. It's Merrick Garland, and I believe the other one's Trump's nominee is Pam Bondi. So I think as a result of that, you're going to see a lot more business friendly policies moving forward. And I just wanted to point those out as we move and talk more about the economics of what's going to do that. Those have already happened, and those are very, very good news for people in business in general, and certainly for those who in the real estate market investments. I think that's going to bode very well for them. So, Arleen, do you want to add anything else to that?
No, I think, the more that the federal government stays out of mandating things for us as owners and investors to do, I think the better. So I think those were all very positive things to see. And, we're expecting that this administration will be very business friendly. So that's always good. Now, let's talk a little bit about some other things that we've seen of late. We did host a webinar with JP Conklin, who heads up Pensford, is the company we buy our interest rate caps from, and Mark Brandenburg with Jones Lang LaSalle, who is a big partner to REEP. They've done the last 28 loan transactions for us, and so we trust what they have to say. So I just want to give a brief highlight of what was in that webinar. And if you want to see more, go to our website. We'll have the recording there that you can actually access. So what he was saying, this was right after the last Fed rate cut. That's why it says the Fed cut rates by 25 basis points last week. That didn't happen recently. It happened in early November, but there was a lot of good data on this slide I wanted to share. Chairman Powell, the chair of the Fed, basically said the election won't affect his near-term policy. In other words, the Fed is not a political entity. So we'll see what happens going forward, but there continues to be a path to a neutral stance. The Fed isn't in a rush. Basically, they are monitoring the data very, very carefully. The Fed isn't factoring in Trump's win or possible tax cuts. That they're saying, nope, again, we're not a political entity. We are going to continue on the path that we see is best for our economy. But there are gradual cuts planned. We expect that there will be increased caution near the neutral level, what the Fed sees as a neutral level. The labor market and inflation are cooling. We'll see a little bit more about that. And if you watch those reports, there was a report that just came in recently that did reflect the labor market continues to cool. And we'll see a little bit about where the Fed is really focusing their efforts now that inflation seems to have hit levels they're more comfortable with. But the interesting one here is that Powell did confirm that the president has no legal authority to fire the Fed chair. So again, very, very adamant about stating that the Fed will continue to do what they need to do and will not be influenced by the political elements. So the bottom chart to the right shows some predictions on where the Fed will go with rates. And you can see in 25 at 3.4% rate there, Fed funds rate, and then a continuing drop into 26 and 27. Again, these are predictions, nothing set in stone. We don't have a crystal ball. But I want to say that right there, they were showing to the left, this was a month ago, that there was a 62% chance of a 25 basis point cut in December. Well, that is now in the 80s, in the 80%. So people are really feeling like the Fed will cut the rates again. Now let's look at inflation. This again is a little bit dated data, but I don't think it's changed a ton. It is contained well with enough that the Fed has moved inflation to the back burner and instead is looking at labor. So let's look at what's happening with labor and jobs next. So let's go to the next slide. There we go. So you see there what has happened. The latest labor report did show a cooling, a little bit of an increase in unemployment and also a decrease in non-farm payrolls. So again, the Fed will watch labor more closely as they make their decisions because this data is very, very impactful to the economy.
So Arleen, if I may, I just ran into a economic coming out of the Fed, the Atlanta Fed, that someone just posted on LinkedIn, and it talked about the job growth or the income growth, excuse me, the wage growth, and it saw a 7.7% increase last year in young people from 26 to 24, 7.7. And from the age group 25 through 54, it saw a 5% increase in wage increase. So very positive for us.
It is. I mean, wage growth is definitely one of those factors that's much needed in our economy, especially when you see inflationary measures that are impacting everybody. And, you know, the 25-year-olds, that's our renter group. So it's nice to see that they're getting a wage increase because that will help in terms of their payment of rent. So that's exciting. Let's look now at what we were seeing. Again, this is a little bit dated, but the next thing is what was the election's impact on the Treasury, on the 10-year Treasury? This is based on historical data, again, that Pensford pulled together. And it does show that historically, 90 days following an election, that when the GOP wins, when the Republicans win, that it averaged 0.18% higher when the GOP won. 360 days following the election, the 10-year averaged 0.56% higher when the Democrats won. So there is an impact to rates based on who wins, but really all of this, what we see, it gets priced in way in advance of any sort of changes. So, and, you know, there were a lot of people we heard from, you know, when we were doing our last acquisition that they wanted to wait until after the election. And I think a lot of people have seen that according to this, there's not a huge impact to it, you know, regardless of who wins. There is a little bit, but that's what we're seeing as the election impact on the 10-year Treasury. The 10-year Treasury we follow a lot because our loans, fixed rate loans, are based on Treasury rates. Of late, we've looked at 5-year Treasury and the 10-year Treasury, and there's been a little bit of a move. When we locked the last 2 properties that we bought, Treasuries were down. And then they went up in anticipation of election results. And then now we're seeing the 10-year Treasury coming back down. So something we definitely watch as we looking at pricing any new loans or refinancing new loans.
So I'll also point out some of the economic data coming in from San Antonio and the Houston, which we're highly focused on. We're also seeing those numbers from those micro levels, job increases continuing to raise. Now, one of the things that continues to be in our favor is the affordability gap between buying a home and operating that home and renting an apartment. And it is still the largest gap that we've seen in how many years? Remember?
I don't
12,
remember.
14
Yeah,
years?
it's been uh, rising. In fact, today there's a average $1,200 gap, meaning it's
Interesting.
$1,200 cheaper to rent than it is to buy a new home today. So that's really impacting people's ability to buy a new home because one, rates are higher, mortgage rates are higher, but two, housing prices have stayed high. And a
Well,
lot of that's because they're not building a lot.
I
The
have
inventory of homes hasn't increased.
I have a stat here that Texas has a shortfall in 2002 of 320,000 homes.
Mhm.
And the previous year was 3006. So we've seen that increase. And again, that continues to feed that affordability gap. But we are seeing some wage increase in the younger population, which again is really good for our rent growth. And I don't know if we have a chart showing our rent growth that continues to go up in 2024 when many apartment operators did not see positive rent growth nationwide.
We don't have one in the huddle today, but it
Yeah.
definitely is something that our properties have seen. We've seen a big decline in bad debt, which has been based on a concerted effort by our
Mhm.
teams to get that down. We are starting to see concessions go down in our markets. We're not a concession-heavy company, but it does affect us when other properties that are not in our portfolio are offering concessions. So overall, we are seeing a rent growth, as you talked about, across our portfolio. And so for us, it's about looking at the fundamentals, occupancy, rent growth,
That's the next
et
topic. Should we
cetera.
move on it?
Yep, let's go
Okay.
on. Yeah.
Let's move to the next one. We'll talk about some of the operational things. Oh,
Well,
we want to finish that
can
up real quick.
continue with acquisition. So
Okay.
we wanted to show you the two properties we did buy this year, Oaks, Kingwood, and Sunrise at Atascocita. Both of these properties are located in suburbs of Houston. And actually 50% of the growth in Houston has been in the suburbs as people go looking for maybe better school districts and smaller areas to live in with maybe lower crime. So Oaks and Sunrise were really unique to us because they've been owned by the same owner for 20 and 30 years, which is unheard of. It's the first time we bought two properties in a portfolio that were owned that long. And you might think, well, why would you want to buy a property that's been owned that long? Maybe they haven't kept it up. Well, what we found for these two assets is that the owners did keep it up because this was their retirement plan, right? They're both owners in their 70s and 80s, and they wanted to have a good outcome when they sold them. So they kept them looking nicely. However, 100% of the units at both of these properties were in what we call classic condition. Just means that they haven't modernized them since the 1980s on the interiors of the units. They might have painted the exterior to make it look good, but on the interior, they didn't update them. They didn't renovate them. And we love that because that's our value add plan is to go in and renovate these units and, get a higher rent as residents see the value of these newer, more modern units. So we are painting the exterior of both of these assets to again improve that curb appeal. They look fine today, but we want them to look even nicer and crisper. They are located near schools, near really good schools. And so we know that they're going to drive people to us. One of the properties has townhomes, and one of them has units that were built in the 90s. And so these are the larger units that people are looking for in this area that has good school districts. So those are the two that we bought this year. And we're excited about them. The renovation's already in process. You can see the new signage there. The before signage of Oaks, again, 30-year-old signage versus the new modern signage that you see there. And then the teams, the day we bought the property and took over, you can see the men on the ladders in the middle bottom picture where they've already started prepping the property for painting. So getting the renovation done quickly is important to us because that means we can improve the income and raise the rents faster. What I have on the acquisitions, Jacob.
Okay. So thank you, Arlene. So let's talk about ops for a second. Operations. We're going to spend a little time. I think we've got like 10 minutes left, and we'll just wrap this up. But one of the things I wanted to talk about was in 2023 and 2024, you saw a disproportionate level of available units that were available in our markets in Texas in general. They've been building a whole lot. And the good news is we're starting to see that absorb right now. But let's talk about late 2023 and early 2024 when there was a lot of units and online for renters to rent. There was a easily 85% occupancy across the board. If you look at published reports, and the market was very, very soft. And as a result, operators were left with lots of vacant units. I'm happy to say that in 2024, our average occupancy was 93%. And our teams worked really, really hard to make our properties appeal and reach out and be very consistent with our leasing. So they did their job. We also looked at strategies to say, how can we get more renters approved? How can we get our money faster? We certainly had the marketing, we certainly had the prospects. So we took a look at why we're missing out on denied applications, and many of them had great rental history. They had good jobs. They just weren't the 3x revenue or income to ratio that we'd like to see. They 3 times the rent. They were falling 2.8, 2.6, 2.7, and they were being denied. So we were able to find a company that would act as a guarantor and guarantee these leases. And as a result, we signed 100 leases, and it's still ongoing. The program is, and that's worth $1.3 million to our portfolio. So that was a huge win for us. And there's nothing harder to tell a leasing agent you can't pay them commission because everybody did their job. Just the resident wasn't as qualified as we'd like them to be. So we felt like we were able to come in and provide that gap and still not risk our revenues coming in, and found a company to do that. That worked extremely well for us. So the other one we did was, with the rents coming up and inflation, you start seeing that 2x, 2.8x instead of a 3. You'll start seeing more late payers come in, and they'll eventually catch up at the month. And what I mean by that, they'll make most of the payment on the first, and they'll come in and 10 days later make the final payment, and then to be caught up. And that's kind of we saw that as a recurring theme. And again, they're struggling, fellas. They really are. Inflation's really whooped them. So we forged a relationship with a company that on day one, on the beginning of the month, we're paid 100% of our rent. And they will make arrangements with this company to pay on the 1st and the 15th. Again, great renters, they just don't make enough money to pay it all at once. So they make the payment arrangement with them, and we get our money up front. And that helped us as well for cash flow reasons on our property. So those are the 2 biggest wins that we've had this year and a half as things got a little tougher for us. And that I think speaks very well of our properties, because all of our properties are in cash flow wise, they're in really good shape. So those are 2 big wins for us. The other things that we always look for is how can we take some of our technology and make it better. Again, we took a look about what we were, and if you look at property management software, it has a lot of different ancillary products built within the software, the core product, as far as other products that you can add to that. So we ended up having 24 different ones outside the accounting core product. And we thought, wow, that's a little too much. So we actually scaled that back to 14. So we kind of almost a third of that. So some of the redundancy that's in there, that just provided some real clarity for us. And that was a big win for us. The other one is we focused on occupancy collections, delinquency, and renewals. And if you look at a rent roll, you will see all of those four major core, what I consider strategies, all on a rent roll. So we created some business intelligence here in-house that allows um, the leasing and the managers to create on-demand reports. We're talking live on their phone that deals with occupancy, delinquency, renewals, and collection. So that was another big win for us without getting into too much of that. So and as we all know, there were lots of tailwinds as far as strategy for allowing better net operating income in the last 5 to 7 years. And what we have found out in the last 2 years is um, having our operations basically go back to the basics. And so I think we've done a really good job of just staying building block, doing basic training with our operations staff, and that's really helped us a lot too. All right, that's all I got on that one.
Okay, well, except before we go from this slide, I just want to, speak to the fact that this is a business that is run by people, and our teams do a really great job of taking care of the residents. That's the mantra, the number one thing we share with our team in terms of our vision on how we want to see these properties and the residents cared for is take care of the resident. They put money in everybody's pocket when they pay the rent. But the number one reason people leave is because of service. So service is the number one thing that we really spent a lot of time on. We call it the REEP difference. The teams are trained on the REEP difference in taking care of the residents. So you can see here some of the wonderful feedback that we're getting from our residents, and that helps us on leasing. These are the feedback, we all look at restaurant reviews, right? Before we go to a restaurant. Well, the same thing happens with residents before they move to a property, is they do check the reviews. And so
Google, it's
yeah,
huge.
yeah, we're
Yep,
very thankful that, and we monitor this.
We're very
on a
intentional.
monthly basis. The
Very
teams
intentional.
know how they rank in terms of their reviews. And so we wanted to share these with you also as a nice positive thing, what we're seeing. And here's some more community support. So, our properties, what we really strive for is to create a community. Yes, there might be 8 to 15 buildings on a big piece of land, but it's honestly the community feel that people will look for when they're
It's their
looking to
home.
rent. Yeah. So these are some of the resident events, the pictures you're seeing that our properties have hosted with residents, everything from Halloween to Cinco de Mayo to backpack giveaways when school is starting. So these are the things that really allow our residents to say, you know what, I like living here because it feels like a community. And they'll refer their friends, they'll refer their relatives to the property because of the community feel. So again, really proud of our teams for making residents feel part of a community.
And here's a difference maker, right? I mean, it starts with our culture here. And I can't say enough about how our teams have come together and to help each other and to help each other grow, to get up. And I think that we've done a good job of outlaying our mission, having our sense of purpose, why we're here. And they come to work every single day and they are absolutely ready and they know what they're doing. They know these are investment properties. And they also subscribe to, we take care of the resident and we're well capitalized and we have the systems in place and we're well operated and well run. Well, they're going to be able to do the jobs much easier. And you can just see the smiling faces there. It's one of my favorite parts. It's going on site with these fellas. They're really good.
I agree. And what you're seeing here, the top two pictures are our family picnic. We invite our teams to bring their family. You see the bus behind there. We bring the Houston team to San Antonio on a nice bus with TVs so they can enjoy their trip to San Antonio. And then we have games and some other things that we do at the family picnic to build that bond among the team. And it's a fun time for us because we get to meet the families. And honestly, that our team members, if they are supported by their family members, they'll stay with us. They'll continue to be part of the REEP family. On the right, you see our family picture at Through Project Gala. That's a project that, or an organization that, as a family, we decided to support. They help kids that age out of the foster care system. And when kids in the foster care system reach the age of 18, they basically have no home. So this organization provides housing, food, and these kids get to go to college, but they can't go to college if they don't have a place to live or a way to get there. So
Is college paid for by the state of
it's
Texas?
paid for by the state of Texas because they are in the foster care system or have come out of the foster care system, but they don't get paid their rent. They don't get paid food or transportation. So the Through Project does that. And happy to say we have 6 of the Through Project college kids that live at a REEP property today. And this is a personal donation that Jacob and I and our kids have made to the organization.
To support those.
Those
rents.
Definitely. And then you see our teams at least 3 times a year. We bring the teams together. You see the bottom picture, REEP Rising. And we share with the teams what is our strategy and how do they fit into the overall strategy? How does their work impact the company as a whole? And we've seen it, and we've had, maintenance guys who tell us that they've worked at other companies and they were never invited to a company meeting like this.
And they'll also say things like, I had no idea properties were acquired like that. I didn't know the process, and I didn't know that the equity structure. Is that right?
Right.
And even we learn a lot on the ops side because we're in here buying stuff, and on the operation side, our teams understand what really happens on the ops side. So as Arleen was saying.
Yeah. Yeah. And, it is about the culture. And we are proud to say that once again, we were named a top workplace because of the submissions or the nominations given by our teams. And so that really warms our heart to know that they love where they work. And that's our goal. That's our mission, is to continue to provide a great place for development opportunities and for a place that people will love to come to work at. And so that it's a great way for us to really see what they're doing and include them in everything that we're doing as a company.
Okay, let's wrap this up now. I think the next thing we're going to talk about is our next webinar. And
Yes.
who do we have, Arleen?
We have Dr. Peter Linneman. He has been educating people on talking about the economy for the last 32 years, I believe he said. A very well-known individual, and he's going to talk to us more about what is the economy doing, how does it impact multifamily. I think a lot of great information that you'll want to hear. And so there's a QR code. You can always go to the REEP Equity site also and register. And we hope that you will join us on January 14th. But just talking about education in general, the huddle. I want to talk about this REEP huddle. It was an idea that our director of marketing came up with, and I remember her saying, don't know if we'll get folks on, what's going to happen, but we're going to try it. And it's another way for investors, potential investors to hear about what's going on, to get a chance to talk to us, to ask us questions. And proud to say that we've had over 1,000 people register for these REEP huddles. And so we're going to continue doing them because people want to hear about what's going on, and we will continue things like this webinar coming up. We believe that continuing to share and educate investors is also a thing that we need to continue to do because our investors ask for it and they appreciate that we've done it. And so you'll continue to see us next year, and we hope you will join us. 2024 was a great year, slower year, as we talked about in terms of acquisitions, but it was a year focused on, as Jacob said, the fundamentals, We buy properties at a good price, but the magic truly happens in the operations side of it as our team goes to work creating value at these properties. So that's what we have today. Jacob, do you have anything else you want to share?
No, I think you covered it, and I think we'll conclude with that one if you're good.
Great. Well, we want to wish everybody happy holidays. This is a special time of year, and we also want to wish you the best in the coming year.
Good night, or good day, everybody. Thank you for watching.
Bye-bye.